Bitcoin has once again shattered its previous all-time high, breaching the $120,000 threshold today and adding roughly 15% to its value so far this month. As the third consecutive monthly green candle comes into view, it's hard not to marvel at the explosive momentum and upswing, primarily fueled by institutional capital pouring into spot Bitcoin ETFs, most notably BlackRock's IBIT. Yet behind the fanfare and record headlines lies a more nuanced story of on-chain health, potential roadblocks, and the true sustainability of this rally. The headline catalyst is unmistakable. IBIT's assets under management just surged past $83 billion, setting a new benchmark for ETF growth. In a mere 200 trading days, IBIT tripled its AUM feat. That took the flagship gold ETF GLD over 15 years to accomplish. Bloomberg ETF guru Eric Belhunas highlighted the magnitude of this record. IBIT eclipsed the $80 billion mark in just 374 days. 5 times faster than VOO's prior record of 1,814 days, vaulting IBIT into the ranks of the world's 21st largest ETF. Perhaps even more telling is IBIT's Bitcoin holdings over 700,000 BTC, roughly 100,000 more than Strategy's reserves, illustrating that BlackRock isn't just gathering fees, but dominating the underlying Bitcoin market. Such institutional demand addresses one of Bitcoin's long-standing critiques: market depth. When retail-driven spikes dominated prior cycles, prices often toppled under their own weight. Now, with hundreds of billions parked in regulated vehicles, selling pressure may be absorbed more readily, creating a smoother upside for long-term investors. This may feel like the maturation of Bitcoin from fringe asset to mainstream financial staple. And yet, imbalances can occur. When one product IBIT commands such outsized influence, the risk emerges that any hiccup in its operation, sudden redemptions, or regulatory shifts could cascade into broader market volatility, undermining the illusion of stability. On-chain indicators paint a complementary picture. The long-term holder net unrealized profit loss LTH NUPL sits at 0.69, comfortably below the 0.75 threshold often associated with euphoria in previous cycles. During the bull run in early 2021, NUPL remained above 0.75 for 228 days. Today, Bitcoin has only spent around 30 days in that zone. From a contrarian perspective, this suggests the market is far from overheated, implying further room to run before profit-taking mania sets in. Yet skeptics caution that NUPL alone doesn't capture the full spectrum of investor behavior. Whale accumulation, retail FOMO, and derivatives positioning can all distort perceived breadth of optimism. Network fundamentals reinforce the cautious optimism narrative. CryptoQuant's Axel Adler Jr. notes that average daily transactions have inched up from 340,000 to 364,000 over the past 2 days. A healthy sign, but still well shy of prior peaks between 530,000 and 666,000 transactions per day. This incremental uptick suggests growing user engagement without overwhelming the network, but also underscores that Ethereum and other blockchains continue to capture substantial share of on-chain activity. A stagnation in transaction growth even amid price rallies raises questions about how deeply Bitcoin's use cases are expanding beyond speculation. Perhaps the strongest on-chain bullish signal is the explosive growth of accumulator wallets, addresses exhibiting sustained net purchases without meaningful outflows. CryptoQuant places the combined holdings of these wallets at 250,000 BTC, up from 148,000 BTC at the end of June, marking a 71% increase in just over a month. That kind of accumulation, over 100,000 new BTC, in the hands of those prepared to HODL, creates a genuine supply crunch, tightening liquidity and adding fuel to the rally. Nonetheless, every surge in demand must be matched by actual liquidity in the market. Critics warn that ETF inflows, while headline grabbing, can mask more complex flows beneath a TC desks, trading desk arbitrage, cross-custody settlements, all absorb BTC, but may not always translate into new long-term holders. Furthermore, Traditional markets have witnessed episodes where ETF runaway successes led to congestion, NAV premiums, delayed creations, redemptions, and systemic stresses. If IBIT faces unexpected redemption requests, the domino effect could spark sharp price swings. Macro factors also loom large. The Federal Reserve's communications around interest rates will be scrutinized in the coming weeks. If the U.S. economy shows resilience and rate cuts are delayed, Bitcoin may lose some risk asset luster, prompting a rotation back into yields. Conversely, if inflation cools faster than expected and real yields slide further into negative territory, Bitcoin and by extension IBIT become an even more compelling hedge, drawing the next wave of capital from traditional portfolios. In parallel, geopolitical tensions and banking sector fragilities continue to push institutional treasuries toward Bitcoin. Companies seeking non-sovereign reserve assets which can't be frozen or debased at will find Bitcoin's transparent, verifiable monetary policy attractive. Yet regulatory headwinds in major markets such as the US and Europe remain unresolved. The Securities and Exchange Commission's moves on crypto oversight, potential tax changes, and KYC AML requirements could dampen institutional appetite or shift flows into unregulated corners, introducing fresh uncertainty. From a risk control standpoint, traders should monitor the $115,000 to $118,000 zone as critical support. A breakdown there, particularly on rising volume, might invalidate the recent breakout narrative and trigger a swift retest of the 200-day EMA currently near $110,000. On the upside, sustained close above $125,000 could ignite momentum algorithms and retail FOMO, accelerating flipside short squeezes and driving a parabolic ramp toward $150,000. The interplay of ETF flows, derivatives positioning, and macro catalysts will determine which scenario unfolds. Longer term, the question becomes whether Bitcoin can maintain its market share and narrative dominance even as nascent technologies, CBDCs, DeFi 2.0, tokenized real-world assets, compete for the same capital pools. Bitcoin's strength has always been its simplicity, a sound money protocol with capped supply and robust security. Yet complexity breeds innovation. And if financial markets gravitate toward multi-asset tokenization frameworks built on programmable blockchains, Bitcoin may find itself sidelined as a pure store of value asset in a broader digital asset toolkit. Ultimately, Bitcoin's new high above $120,000 and the record-breaking growth of BlackRock's IBIT signal a maturation of institutional engagement. The confluence of on-chain accumulation, a non-euphoric NUPL environment, and stable but rising network activity suggests potential for sustained upside. However, the twin specters of regulatory uncertainty and market concentration in a single ETF caution against unchecked exuberance. Traders and investors must balance the tailwinds of ETF-driven demand with the inherent risks of a nascent, tightly wound market. In the end, Bitcoin's journey to $4,000 or $200,000 will depend not just on headline metrics, but on the resilience of its market structure, the depth of its liquidity, and the evolution of its regulatory environment. As IBIT and other institutional vehicles continue to scale, the interplay between institutional flows, macro policy, network health will shape Bitcoin's next chapter and whether this historic rally can endure beyond the headlines.